In this week's video, we'll review a stock market signal that's only been flashed 6 previous times in the last 91 years. And we'll be asking and answering, does this signal align with or contradict the secular trend thesis? And prior to getting to this signal, a quick review of context might be helpful. When the market started to fall in February of last year, we noted that cyclical periods within a secular trend can be marked by painful pullbacks, serious corrections, recessions, and bear markets. For example, the total peak-to-trough drop in 1987 was 33.51%. Thus, this was an anecdotal example telling us that really bad things can still happen within the context of a secular trend, and it doesn't necessarily derail the secular trend. And when the data started to improve in early to mid-April of 2020, an incredibly important component of that improvement was the fact that the S&P 500 was able to relatively quickly recapture an upward sloping 200-week moving average. The chart on the right side of your screen is dated April 17th, and it was covered on April 17th. Now let's talk a little bit about why the recapturing of the 200-week moving average was important relative to the sustainability or resumption of the secular trend thesis. The 200-week moving average is shown in red on the screen. The S&P 500 is shown in blue. Let's start in the upper right-hand corner of the screen because this period is more familiar to more people watching the video. This is the peak in the S&P 500 in 1999-2000, and this is a period of long-term consolidation. And notice, during that period, two things. We can draw horizontal lines in here. This is the peak in 2007, and we can hit price several times, and price tends to drop below the 200-week moving average for long periods of time, as shown here and here, and it's not unusual for the 200-week moving average to roll over in a bearish manner. Everything that we just said about this period in the upper right-hand corner of the screen is true relative to this sideways period of consolidation, long-term consolidation in the 1970s, and it's also true here in the 1930s and 40s in the lower left-hand corner of your screen. These periods are in sharp contrast to the look of price action relative to the 200-week during the secular periods. In each one of these cases, we can hit price several times. Lower left-hand corner of the screen, if we draw horizontal lines, we can hit price several times drawing horizontal lines. That is not the case during a secular trend. And notice in this period here where my cursor is, from 1950 to 1968, price for the most part is above an upward sloping 200-week moving average. Same thing can be said here. If we go to the early 1980s where my cursor is, for the most part, price stays above an upward sloping 200-week moving average, and thus it was important for the market to recapture that 200-week in a relatively short order if the secular trend thesis were to remain intact. And looking at this chart here, it's fair to say that the present day looks a lot more like the secular trend period here and the secular trend period here relative to the three periods bounded by the orange boxes. And since April 17th of 2020, the S&P 500 has remained above the 200-week moving average. Which brings us to a long-term and rare signal that was flashed on March 31st of 2021. It was a quarterly chart of the S&P 500 dating back to 1930. Bottom of the screen is the Commodity Channel Index, affectionately known as CCI. Right-hand corner of the screen is the present day. CCI is above 200. If we draw a horizontal line at 200, you can see ending a quarter above 200 is relatively rare. In fact, it's only happened 6 previous times in the last 91 years. 1951 here, 1955, 1981, 1984, 1986, 1995, and then 2021. So here are the years where the 6 previous signals occurred. And something that just happened in the present day ties 2021 to 1951, 1955, 1981, 1984, 1986, and 1995. And notice, it does not tie the present day to any of these periods here inside of the orange boxes, nor does it tie the present day to something right before entering the orange box. At this point, you're still roughly 5 years away from entering the orange box. So where do these 6 years show up on this chart that we covered previously? The answer, 5 of the 6 signals occurred at the relatively early stages of a secular trend in the S&P 500. Relatively early stages, and even here, there's still 5 years left to go, and look at the run in the S&P 500 after this signal in 1995. We don't have any of these signals occurring here, here, in this period here, here, or in this period here, and that is extremely noteworthy as well. It's important to note what periods the signal ties the present day to, and basically what periods it does not tie the present day to. So it's probably fair to say the signal that just occurred just a few calendar days ago, March 31st, 2021, aligns with, rather than contradicts, the secular trend thesis that we've been talking about in these videos for years. Thus, it might be helpful to know, how did the S&P 500 perform walking forward from the 6 previous signals? Secular means long-term. Thus, this is a long-term signal, and it speaks to long-term probabilities. 3 years from the date of the signal, 100% of the cases higher. 4 years, 100% higher. 5 years, 100% higher. Median gain 3 years out, 30%. 4 years out, almost 62%. 5 years out, 65%, with the average gain 5 years out eclipsing 80%. Any quarterly signal is going to speak to longer-term probabilities. Thus, it might be helpful to know, what can we learn if we look at a wide array of the charts in front of us on shorter-term time frames, and can we see anything in the present day that tells us a Nordic peak, an intermediate-term peak within the context of the secular trend, might be right around the corner? I'm going to be moving very, very quickly here. This is NYSE high-low stochastic. It's the S&P 500 lower left-hand corner of the screen. This is the COVID plunge. Notice during the COVID plunge, the stochastic never bounces back above this orange line here. As of the close on April 1st, we're already back above the orange line. Just a subtle difference, but a significant difference. We'll be reviewing a lot of monthly charts, and thus they will be dated month end. This one, March 31st, 2021. Value line geometric index is still holding in an incredibly long-term breakout. This is foreign stocks relative to the S&P 500 monthly. In order for us to add a significant amount of foreign stocks to our portfolios, a chart like this is going to have to improve. It remains in a relative downtrend relative to the S&P 500. That may change. It may change soon, but it hasn't changed yet. A lot of longer-term charts are at possible inflection points. Here's one example. This is clean energy relative to traditional energy. At this point, we don't know if this is going to be a successful breakout and a successful retest or a failed breakout. Somewhat of an inflection point look on home builders as well relative to the S&P 500. It's reversed up in this area numerous times dating back to 2008. This is a very long-term period of relative consolidation, and if it can break out successfully and hold above into this area here, really, really good things could happen in home builders. This too is a cross-current chart telling us it's possible It may make sense to get rid of our home building stocks, or it may make sense to significantly add to them. Charts like this may lead to some short-term and choppy allocation changes. The objective here is not to look smart in the short run. The objective is to push our ego aside and get allocated properly in the long run. And what that means is, it's possible we could cut home builders and then add back to them relatively soon. And that statement is true for almost any stock-related ETF in our portfolios right now. Here's another one, value versus growth. If we draw a trend line here, it's possible that value versus growth could hit that trend line and this rally could fail. It's also possible that value has a long, long way to go versus growth. From a trend perspective, this is not really an attractive long-term trend for value, but at some point trends reverse. This is VUG relative to SPY. Momentum is waning here. MACD rolling over. This is a vulnerable look here. Is it possible growth relative to the S&P 500 will right itself? Absolutely, it's possible. Here's a chart that's in a bullish long-term trend but looks vulnerable. Again, we have cross currents. This is one of a handful of charts that will speak to Nordique probabilities. What is Nordique? Nordique is that the market rallies at this stage of the bull market and then gives a large percentage of that or all of it back. Nordique probabilities increase if we start to look like this. You can see the S&P 500 falling where my cursor is. Same thing here. Get a big spike in the indicator, S&P 500 tanks. We got a little tremor here, but this is settled down right now, and thus far, it really doesn't look that bad. Really, everything that we said about the growth versus S&P 500 chart applies to tech versus the S&P 500. Cross currents. We're going to have to remain highly flexible with our allocations. Nordique probabilities would increase if this indicator gets into this area here and stays there. Thus far, it's pretty much done just the opposite. It's come down to an area where it's held before, and thus far, it's held. That doesn't tell us it's going to hold, but right now, this is telling us to keep an open mind about the NASDAQ rallying. Same message here. NASDAQ advance decline volume line, making a new high, upper right-hand corner of the screen, before the NASDAQ makes a new high. April 1st, volatility index making a new low for the entire rally in the stock market off of the March 2020 low. Also noteworthy, the VIX is well below 20. Another example of allocation cross currents, equal weight S&P 500 relative to the S&P 500. It's pretty clear from a long-term perspective in the slope of this 50-month moving average where my cursor is, that equal weight is still in a long-term downtrend relative to the S&P 500. We closed above this downward sloping trend line. So the cross current is the longer-term trend is in conflict with the intermediate and shorter-term trends. How do we figure it out? We trade the chart in front of us. Again, it might be a little choppy and a little dicey with allocations until these things sort themselves out. This is the same chart, it's just a broader perspective, and you can see if we drew a trend line here, when you started to approach the 50-month moving average, there was a little hiccup in that trend, but eventually it broke to the other side. Also noteworthy, this is the low in 2009, and we know the present day or the low in 2020 shares a lot with this period, telling us to keep an open mind about some type of hesitation on this chart in this area, but eventually keeping an open mind about a bullish breakout. On the daily chart, we have a shorter-term bullish breakout, and right now we're holding above. It's possible we would move back and retest this area. Here, we'll just see how it unfolds. NYSE common stock only new lows. This is what increasing fear looks like where my cursor is. This is what increasing fear looks like. This is what the present day looks like. We don't really have anything that's screaming imminent Nordique at this point. And as we pointed out last week, it's incredibly important that we don't get stuck on a story. We trade the chart in front of us. This is the chart in front of us. Another example here, 2009 case where my cursor is. See, we get a little bit of a hiccup on mid-caps relative to the S&P 500 when it comes back to the 50-month moving average. We've got a little bit of a hiccup here. Since this downtrend started in 2015, monthly RSI has never had a close above 50 until recently, telling us to keep an open mind about this morphing into something like this over here. Another example of broadening out, equal weight tech relative to the tech sector. Another cross-current chart, kind of stalling at a logical area, KRE relative to SPY. However, in the past, when we've gotten a momentum turn down here where my cursor is, we made it back above the 50-month moving average. Got a turn here, we're above. We get a turn here, we're above. This is an even more impressive turn, telling us we should keep an open mind about getting above this downward sloping 50-month moving average, which we haven't done yet, and then we'll determine whether or not we can get a breakout and reverse this long-term downtrend. Again, cross currents. Shorter term, regional banks have been killing the S&P 500. Longer term, it's the other way around. Industrials relative to the S&P 500 in 2009, industrials relative to the S&P 500 in 2020 and 2021. It's a monthly chart of the Bitcoin Trust, GBTC relative to the S&P 500. Long-term period of sideways consolidation. It is holding the monthly breakout above this level here from 2017. The longer it holds, the more relevant it becomes. This is down to a daily time frame, Bitcoin relative to long-term treasuries. You can see also holding above this high that was made late in calendar year 2017. This is the chart that tells you if you're expecting your balanced portfolio to work the same way over the next 20 years that it did in the last 20 years, you may be extremely disappointed. Right now, we have a very long-term period of consolidation of stocks versus bonds, and what right now is a bullish breakout above this level here. Shorter term, this is a very sharp move. Any trend has counter-trend rallies along the way. But this, too, aligns with the secular trend thesis. If stocks are going to lead, we would expect bonds to lag and this chart to move in this direction. The longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or a bearish breakdown. This is retail versus long-term treasuries. You get a momentum cross here after the major low in 2002, 2003 in the S&P 500, a momentum cross after the major low in the S&P 500 in 2009, and guess what? We just got a momentum cross on the same quarterly chart nailed down on March 31st, 2021. Intermediate treasuries versus long-term treasuries. This is what increasing fear looks like during the COVID plunge. This is what the last few months looks like. We do have a little bit of a hiccup in here, but this is still in even a shorter term uptrend. This over here on the right side of the screen looks quite a bit different than this over here. Pretty much everything that we just said about the last chart applies to this chart. This period here really doesn't look anything like the right side of the screen. Applies to this chart as well. Corporate bonds relative to treasuries. It speaks to credit risk versus yield. This period here, this is the COVID plunge in the stock market. The present day is not plunging. In fact, we just broke out above this level here. This chart was dated March 31st, and this ratio was up on April 1st as well. March 31st, JNK relative to IEF holding above this level here. Really hard to make the argument that the present day looks anything like this period here. All of these statements are based on the charts in front of us. They may change soon, but they haven't changed yet. What once acted as resistance may now act as support, may now act as support. We've also got horizontal support in this area. Leveraged loans, that basically means risky loans. Trying to make a stand here, we'll learn something either way. Stocks versus bonds. Once again, the right side of the chart doesn't really look like the COVID plunge over here where my cursor is. This is March 31st, S&P 500 relative to defensive staples. You can see there's a little bit of a defensive move here in recent weeks. It's possible that this is a retest of the breakout above this level over here. If a Nordique phase is right around the corner, we would expect this ratio to drop down into this area here. Right side of the screen, this is a breadth indicator tied to the NASDAQ. This is somewhat of a dicey look in here. Look how much it's improved recently. Here's the look of the indicator during the early stages of the COVID plunge. Here's the look of the indicator in recent sessions. If we're trading the chart in front of us, we really don't have anything right side of the chart here on April 1st that says a Nordique phase is imminent. If this indicator dropped and stayed into this area here, our concerns would increase. That may happen soon, but it hasn't happened yet. Here's another chart, S&P 500 stocks greater than their 200-day exponential moving average. This is not screaming imminent Nordique phase, but as we've mentioned in previous videos, this look can change very, very quickly. So the comments that we're making are based on the chart in front of us, but the chart in front of us just had a little period of weakness here, and then it went on to print a higher high, and recently printed the highest high that it's had for the rally. That's the good news. The bad news is this is extended, and it's probably not going to stay up here forever. But there's not a lot of evidence to say yet that it started to move in the wrong direction. MarketWatch article, the stock market could double by 2030 because COVID has utterly changed the policy environment. We could probably do a 1 to 3 hour video on this topic, the number of changes that have taken place at the Fed and relative to fiscal policy, the U.S. government. These are significant changes. Frankly, changes that align perfectly with a secular trend. Fed policy in this box here and fiscal policy coming out of Washington significantly different than what we have in the present day. And again, noteworthy, something that we just saw in 2021 ties the present day to these periods here where my cursor is. And from a longer term perspective, good things happened for a long period of time. It's very, very easy to see a table like this and think the stock market's going to go up every day. We all know it can't work that way in the real world. Out of these 6 cases, 3 of them had next to nothing in terms of drawdowns. But the other 3, looking out 1 year, had pretty significant drawdowns. If we experience drawdowns like this from the date of the signal in the present day, the S&P 500 could push backwards or backtrack anywhere between 39.21 and 35.22. This range here is very, very similar to the range that we've been showing in recent weeks. This would be a Nordique type move where it's possible the market goes up and then eventually sometime in the next 156 to 91 calendar days comes back, tags 3,500, and then rallies again. In terms of not getting stuck on a story, this helps a lot. This table here helps us keep an open mind about a wide range of outcomes looking out 12 months. Drawdowns might be extremely muted or they could be pretty painful. And you have to keep in mind, these are S&P 500 drawdowns. Those drawdowns can be quite a bit bigger for small caps, mid caps, tech, banks. This is the market. The signal we covered told us that something that just happened at quarter end tied the present day to periods inside of secular trends in the past. You can pause your video player here. Ryan's tweet and this blurb here from CNBC tell us here are two more things that just happened. One of them ties the present day to 1982, and the other one right here ties the present day to 1983. And that's right here at the relatively early stages of a secular trend. Here's another one, something that was just nailed down on March 31st. You can pause your video player. Last time we saw it happen, 1995, right in here. And after that, good things happened. Really good things happened over the next 4 to 5 years. You may remember watching these videos. Back in here, we said we should be open to a change of character. This is what we had in the rearview mirror from a trend perspective. This is what we've morphed into. This is what a very, very strong trend looks like. And in this case, a very, very strong part of a secular trend. The look of this chart in the present day and the fact that the S&P 500 has stayed up and held up so well, even when the NASDAQ had a significant give back. Small caps have had a pretty big give back. Mid caps, banks. But this look here helps us keep an open mind about better than expected outcomes and helps us keep an open mind about something over the next 12 months more in alignment with these three muted drawdown cases relative to these three cases. On April 1st, 2021, it's really hard to say we've got any major trend problems here. So given what we know today, the long-term outlook remains favorable. At this point, we have no significant evidence in hand of a Nordic peak in terms of it being imminent. And there may be a message in recent strength. We had some technical weakness, some breadth weakness, and the market has held up. And there may be a message if we see strength walking forward in the next few days and weeks. And that message would be, we have to remain open to a continued strong trend with relatively muted drawdowns over the next 12 months. 3 of the cases tied to the signal this week help us with that. 3 of the cases help us keep realistic expectations about 100% normal and to be expected volatility, and the possibility of significant 8 to 11% givebacks over the next 12 months. And remember, those 8 to 11% givebacks are based on the date of the signal. From the peak, they could be even bigger. So how do we handle all this? Take it day by day. We make no assumptions about anything, about what tomorrow is going to look like, and we don't get stuck on any story, any bearish story or any bullish story. We don't get stuck on a 1995, 1996 story, and we don't get stuck on a Nordic story. And we all know the best way to do that is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.